A lease purchase option is an option for the lessee to purchase the leased asset, usually at the end of the lease term. Where the lessee is reasonably certain to exercise the purchase option, the expected cost of this is included in the cash flows discounted for purposes of determining the lease liability. Let's look at an example. We have an entity that has entered into a lease arrangement for an asset for 5 years. Payments are $100,000, payable at the end of each year. The interest rate is 5.00%. This lease has a purchase option for $250,000, which the entity is reasonably certain to exercise at the end of the period. This is payable at the end of the final year of the lease term. Now, how do we account for this? First, we need to calculate our lease liability, as we normally would for a lease, by plotting out our cash flows over time and discounting them back to the present value. Now, when we think about our actual cash flows over the term of the lease, we can refer back to the scenario. We have fixed payments each period of $100,000 payable at the end of each period. We also have the lease purchase option payment to consider. We can plot these fixed payments of $100,000 per period as such. We know that our lease purchase option is also payable at the end of the final year of the lease term. As such, we can add this to the fixed payment to arrive at a total payment of $350,000 in the final period to be discounted as part of our cash flows in determining the lease liability. With our cash flows sorted out, we can calculate the discount factor. This slide has been included for reference. Please pause to read if you need to, otherwise check out the video on simple leases for more detail. And we can then multiply these through to determine our discounted payments and total them to arrive at our lease liability. Let's look at the right of use asset now. We don't have anything to concern us in regard to the right of use asset. We can simply take the lease liability value. With these initial measurements, we can prepare our lease liability and right of use asset schedules from which we will post our journals. Before we do that, we can debit our right of use asset and credit our lease liability for the amount calculated to recognize them in our accounts. Our lease liability schedule will begin with our initial measurement of the lease liability. We can then add interest by applying the interest rate to the opening balance. We can then deduct our payment for the period. This will give us the closing balance for the period, which will be the next period's opening balance. We can follow this through for each year of the lease term. If we have done it correctly, the closing lease liability in the final year should be zero. Each period, the interest can be debited to interest expense and credited to the lease liability. We can then debit the lease liability to the extent of our payment for the period and credit cash or payables. Moving on to the right of use schedule, we can once again begin with our initial measurement of the right of use asset. We need only to calculate our depreciation expense and deduct it each period to arrive at the closing balance. This is calculated as the initial measurement divided by the number of periods of the lease term. In this example, it is 5 years. The closing balance for one period becomes the opening for the next, and we can follow the calculation through each period. Again, if done correctly, the right of use asset in the final period will be zero. Each period we can debit depreciation expense and credit accumulated depreciation right of use asset. And with that, we have appropriately accounted for a lease purchase option under IFRS 16 leases. Thank you for watching. If you found this video helpful, please like, subscribe. Feel free to comment any topics you would like to see addressed in future videos. Check out financialreporting.wtf for more. See you next time.